To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Now, so far in our discussion and in the example that we discussed just now, we understood what is the current service cost and we also understood what is a defined benefit obligation and how do we compute the present value of defined benefit obligation, right? Now, these are the three key terms that you need to understand before we move further. When I say defined benefit obligation, we are looking at what is the obligation under the defined benefit plan. And at the end of each year, the obligation on the employer is nothing but the present value of the defined benefit obligation for services already rendered. And what is the meaning of current service cost? Current service cost is nothing but the part of benefit which is attributable to the service rendered in the current period, right? So, I have seen that the final obligation is attributed or allocated to each of the year and we calculated the present value to arrive at the current service cost. Now, to this current service cost, every period will add the interest cost and whatever is the closing balance, that is nothing but the present value of the defined benefit obligation for services already rendered. Now, before we move further, let us understand what are the various things that could impact the defined benefit obligation. See, when we talk about gratuity, we said there is a formula: 15 days of salary for every completed year of service multiplied by last drawn salary, right? Now, it's not just one employee, correct? There are hundreds and thousands and lakhs of employees in an organization. So, what are those factors which would impact the final benefit obligation? One thing is obviously the number of years of service. If we assume that the employees on an average would work for 5 years, there would be one amount of obligation. If we say no, employees would actually work on an average for 6 years or 7 years, as we keep on increasing the average expected year of service, the final obligation would also change, okay? Then there could be an impact of, the discounting factor, interest rate changes. There could be an impact of number of employees who would leave the organization and who would join the organizations. And all of these are assumptions that we make to arrive at the benefit obligation. See, when you look at an organization, no one would for sure be able to say that how many employees would work for how many years in the organization, and also what would be their salary at the time of resignation or retirement, because salary increment would happen on a year-to-year basis. Sometimes they may give a higher increments, sometimes they may not give high increments, right? And it might also be possible that employees who are leaving the organization were having lesser salaries, employees who are joining the organization who are more experienced will now draw more salaries. All of these factors would ultimately impact the benefit obligation. And as we understood earlier as well, all of these assumptions and estimates are made by actuary and these are called actuarial assumptions. These are called actuarial assumptions. Now please understand, whenever an actuarial assumption changes, there would be a change in the obligation. For example, let us say we assume that on an average an employee would work for 5 years in the organization. Based on that, we would arrive at some amount of benefit obligation. But now let us assume for a moment, as time passed by, the actuary came back and said, looking at the past history and looking at the employees working in the organization, we believe that on an average an employee would not work for 5 years, but he would actually work for 6 years or maybe 7 years. Now, the moment you change this assumption, the obligation payable also changes, right? Because earlier you thought that employee would work for 5 years and accordingly you would have calculated the obligation. Now, for 7 years, the obligation would be higher. Similarly, there could be changes in estimates of salary. Earlier we thought salary would grow by 5%. Now, if we assume that salary will grow by 8%, then again your obligation would change. So, what happens is, as time passes by, every period, the actuarial assumptions may change, and it is not only increase in obligation, there may be a decrease in obligation as well. So, based on this, the final obligation may change and accordingly, whatever is the expense that you recognize in a current period might also change. Say for example, an employee joined an organization in year 1 at some salary and it is expected that the employee would work for 5 years and the salary increase would be 5% every year. Based on that, we calculated the obligations, we calculated the current service cost. Now, in year 3, say for example, the actuary comes back and says, based on your increment in salary and all of that, salary will not increase by 5%, but it will actually increase by 10% going forward. Now, because the salary will increase by 10% going forward, what will happen to the gratuity which is receivable by the employee? The gratuity that the employee will receive will be higher. Now that higher amount of gratuity, is it only for year 3, 4 and 5 or right from year 1, 2, 3, 4 and 5? It is right from the beginning, correct? It is right from the beginning. Now why are we saying here that the gratuity payable will be higher? Because the actuarial assumption for increment in salary has changed, right? Now as far as year 3, 4 and 5 are concerned, we can consider that as a part of current service cost. But what about the incremental benefit payable for year 1 and year 2? That is something what we call as actuarial loss. Actuarial loss. Why loss? Because the obligation has increased. Similarly, there may be a case where the obligation reduces. In that case, we will say this is a part of actuarial gains. So, while determining the overall employee benefits, what happens is we make a lot of actuarial assumptions. Okay, we'll come to the various kinds of assumptions we take. Based on those assumptions, we make estimates of obligation. Now, these assumptions may change year on year basis. Okay, every period there may be changes in assumptions. Now, if because of assumption changes, there is an increase in obligation, then we say there is an actuarial loss or loss on account of changes in actuarial assumptions. If there is a reduction in obligation, then it would be an actuarial gain. Okay, so actuarial assumption is one thing which would impact the estimation of obligation that an employer would be making. This is one category. There could be another scenario where actuarial assumptions may not change, but the employer changes the plan. Now, what am I saying here? Initially, what the employer said was, for every completed year of service, we will pay you 15 days of salary. Now, the employer in the third year comes back and says, for every completed year of service, we will pay you 1 month of salary. Oh wow! So, suddenly from 15 days, it has become 1 month. Now, tell me one thing. Is this a change in assumption or is this a change in plan? This is actually a change in plan. This is a plan amendment. This is a plan amendment which will now entitle the employee will be able to get more benefits. Now, whenever such kind of plan amendments happen, what would be the impact? Take the same example. Year 1 the employee joined. We estimate him to work for year 5. In third year, the employer said instead of 15 days salary, we will now pay you 30 days salary. Now, what will happen? The final obligation will increase. The final obligation will increase. Again here, for year 3, year 4 and year 5, you will increase the current service cost accordingly. But what about the incremental benefit that the employee is entitled for year 1 and year 2? Like for year 1 and year 2, because finally the amount that will be paid will be based on 30 days salary, correct? Now, because there is an increase in obligation, because of change in plan, we have to pay the employee extra benefit for year 1 and year 2 as well. And did we provide for year 1 and year 2? We did not provide. Now, in such a scenario, the incremental benefit which is attributable to year 1 and year 2 is called past service cost. It is called past service cost. Now, please understand, past service cost arises because of plan amendment, whereas actuarial gains or losses arise because of changes in actuarial assumption. This distinction is very, very important for you before we proceed further in this particular chapter. So, what would happen? The first case is changes in actuarial assumptions, like we change the estimated number of employees, or we change the discounting factor, or we change the estimates of salary, or we change the number of years that the employees would work, right? Those changes can also increase the obligation or reduce the obligation. If it increases the obligation, there is an actuarial loss. If it reduces the obligation, there is an actuarial gain. Okay, that is one aspect. The other aspect is there is a change in plan itself. There is a change in plan itself because of which an employee is entitled to higher benefit. Now, whatever is the extra benefit for the current year, we will say it is a current service cost, but there is a portion of extra benefit which is attributable to first 2 years or the earlier years, that is what we call as past service cost. Now, you may get a doubt as to, sir, can there be a plan amendment where the employee get lesser benefits? Yes, even that is possible. The employer may say, instead of 5 years, we will pay gratuity only if someone works for 7 years. That is possible, obviously, if the law allows it. Okay, so employer can have such kind of changes to the plan where the benefits are reduced, and this is called curtailment. This is called curtailment. Now, why is it called curtailment or benefits are reduced? Because if you see number of employees who work for 5 years, they will be more than the number of employees who would have completed 7 years of service, right? So, if you change the plan and if you reduce the scope of the benefit, then it is called a plan curtailment, right? Now, I hope you have understood about what is the impact of changes in actuarial assumption and what is this thing called a past service cost. Let us consider another scenario, same case where employee has joined in year 1. Each year, the employer is making estimates based on actuarial assumptions and providing for current service cost and interest cost. And ultimately, there will be the final value of benefit obligation which has to be paid to the employee. Now, is it necessary that the final value of obligation will be the same amount of settlement that has to be done to the employee? It may be different, right? There may be a case where in the last year or in the last few months, the salary increased because of some other reason or because of some other negotiation, right? That is also possible. So, the final amount that will be paid to the employee will be known only towards the end of the employment of that particular employee, correct? So, how much ever effort you put in making those estimates, the final settlement amount may be more or may be less because the benefit is derived based on a formula, right? So, if the settlement amount is more than the obligation estimation, then there is a loss, and if the settlement amount is less than the estimates of obligation, then there is a gain, right? So, this is called a gain or loss on settlement of the defined benefit plan, right? Now, so far we have understood about what is the meaning of current service cost. We have understood about what is the meaning of past service cost, and there is this net gain or loss on settlement of employee benefits. All these three put together is called service cost. Okay, actual gains and losses are different. They are not a part of service cost. Please understand that. So, what is service cost? Service cost is current service cost plus past service cost plus any gain or loss on settlement of the employee benefit plan, right? Let us have a look at the definition of service cost, and then I'll take you through one example where I'll actually show you what is the impact of what is the impact of a plan amendment and how do we calculate the past service cost before we move further. Service cost comprises of current service cost, and we have already understood what is the current service cost. Current service cost is the increase in present value of the defined benefit obligation resulting from employee service in the current period. So, once the employee renders service in the current period, whatever is the increase in defined benefit obligation, that is what is called current service cost. And please note, when we calculate current service cost, we have to take the present value. Then we have past service cost. What is the past service cost? Past service cost is the change in the present value of the defined benefit obligation for employee service in prior periods. So, the increase in present value of defined benefit obligation is because of services rendered in the prior periods. If it is increased because of current period service, then we call it the current service cost, right? Now, why will this change happen? This will happen because of a plan amendment. It will happen because of plan amendment. What is the meaning of plan amendment? Plan amendment could be introduction or withdrawal or changes to a defined benefit plan. So, it is possible that you introduce a new plan. It's also possible that you introduce a new plan, you withdraw an existing plan, which is less likely the case, or you make changes to the plan. Now, what are these three scenarios? One, there could be an introduction of new plan. Maybe there was no gratuity related benefit plan available in the organization. They have introduced that. Okay, so that is an introduction of plan. Or they might withdraw a plan. Okay, if allowed by the statute and if allowed by the law, existing plan may be withdrawn. And third thing is there may be amendment to the plan. So what you need to understand is when you introduce a plan, what would happen? The cost would increase. So you'll have a past service cost. If you withdraw a plan, what would happen? The obligation would come down. So there will be a kind of a gain. Okay, we still will denote it as past service cost, but denote it as a negative number. Then if you amend the plan, for example, instead of 15 days salary, you say 1 month salary, right? That is an amendment to the plan. Now, because of this, if there is a change in the present value of defined benefit obligation, we call it past service cost. And apart from that, it can also arise out of a curtailment. What is the meaning of curtailment? You are changing the plan in a way that the number of employees covered by the plan have reduced significantly. For example, as I told you earlier, we said entitlement for gratuity is after 5 years of service. Now we are saying entitlement for gratuity is after 7 years of service. Now what will happen because of this change? After this change, the number of employees covered by the plan would reduce, right? All of this would result in changes in present value of defined benefit obligation, and that is called a past service cost. If it is an increase in obligation, it will be an expense item. Otherwise, it will be a gain item, which you will denote it as a negative number, right? So just to finally summarize, what is service cost? Service cost comprises of current service cost, past service cost, and any gain or loss on settlement. Right, current service cost we have already understood in detail. What is past service cost? Past service cost is the change in the present value of defined benefit obligation because of either introduction of a plan, withdrawal of a plan, amendment to a plan, or because of curtailment. And then finally we have net gain or loss on settlement. All of these put together is called the service cost. Now in examination, what you need to keep in mind is, if the question asks you service cost, then you have to include all of these three. If the question asks you only current service cost, and then you have to calculate only the first component or the first part. So let's have a look at the definition of actuarial gains and losses. Actuarial gains and losses are changes in the present value of defined benefit obligation. So here also there is a change in defined benefit obligation. Why? Resulting because of experience adjustments, that is effect of differences between the previous actuarial assumptions and what has actually occurred, and the effects of changes in actuarial assumptions. Now here changes are happening because of experience adjustments and changes in actuarial assumptions. What is the meaning of experience adjustment? We initially would have estimated something. Let us say the salary increment on an average would be 5%. That is what we had estimated. But actually salary increased by 6%. So because of this, whatever is the change in the obligation is a part of actuarial gains and losses. And now if the actuarial assumption changes itself, then even that is a part of actuarial gains and losses. Now if you recollect all of these things, everywhere we are talking about changes in the present value of defined benefit obligation. Meaning to say, there is some defined benefit obligation, and the present value of that at the end of the period for services already rendered, we will calculate that present value of defined benefit obligation. This obligation will change because of multiple reasons. The first thing which causes the change in the present value of defined benefit obligation is the current service cost. That is, because the employee has rendered services in one period, because of that the present value of defined benefit obligation is changing. That is called current service cost. Then we had something called interest cost. Here also present value of defined benefit obligation is changed because of passage of time, right? As time passes, the present value of defined benefit obligation would increase, and interest cost is that component which results in increase in the present value of defined benefit obligation because of passage of time. Then there could be an impact of past service cost. Again here there is a change in the defined benefit obligation because of maybe either introduction of plan, withdrawal, amendment or curtailment. There is a change in the present value of defined benefit obligation. That is called past service cost. Then we had actuarial gains or losses. Even because of actuarial gains or losses, there could be a change in the present value of the defined benefit obligation. The current service cost and past service cost are a part of the service cost. Interest cost is separate and actuarial gains and losses are separate. Now let's understand both this changes in actuarial assumptions and how does it impact our calculation, as well as what happens when there is a change in the plan which results in a past service cost. Now you may not be tested on calculations in the examination, but I believe that to understand the fundamental difference and the way it impacts the computation is necessary, right? Just by reading the definitions and memorizing few stuff will not actually help us to appreciate how things actually work. So we'll take the same example that we have taken earlier in our working, salary at 10,000, annual increment, initial estimates. Okay, whatever these are written here, these are initial estimates. So these are all initial estimates. 7% of salary increase, and accordingly we arrived at the salary at year 5 as 13,108, and we did this calculation as per our previous working, and then we prepared a schedule and calculated what will be the service cost, what will be the interest cost, and what will be this closing obligation. Now this closing balance is nothing but your present value of DBO for completed years. So basically 89.47 represents present value of 131 for 1 year of service which is completed, right? Accordingly each of these represent, if I say 196.84, this is present value of defined benefit obligation pertaining to these 2 years. So if you have to cross check, I think we did it in the illustration as well, but if you have to cross check, let us say we are looking at something at end of year 4. I'm looking at something at end of year 4. So we are looking at end of year 4. What is the total obligation? Obligation will be 131 multiplied by 4, right? That is 524. That is the total obligation, not discounted. What will be the present value? Because we are at the end of year 4, we will have to move forward by 1 year. So the present value factor relevant will be 1 year. So present value at 10% for 1 year will be 1 divided by 1.1. You get 0.9091. So what is the present value? Present value is 524 multiplied by 0.9091, 476.36. Now this is one concept which you have to be thorough with, because unless you understand this, other concepts will appear to be in Greek and Latin, and you will end up just memorizing how to do problems rather than understanding what is happening. So when I say 476, this 476 represents present value of this 524, the cumulative benefit obligation, and because it will be settled after 1 year, we are calculating for a 1 year period and we get this, right? So this is one thing what I wanted you to understand. Now say for a moment that we had initially estimated, the salary would increase by 7% every year, and accordingly we did the calculation. But for a moment, assume that in the 4th year, the salary increase was not 7%, but it was 10%. For whatever reason, salary increase was 10%, and now it is estimated that in the future period also, the salary increment will be 10%. So what will happen to the salary in that case? Let's write down here. So you have estimated salary increase to be revised, which will be 10% in year 4 and 5. So instead of the annual increment what we had initially estimated, which is 7%, now we are saying it will be 10% in year 4 and year 5. So let us note down what will be the salary, years salary. Okay, 1, 2, 3, 2, 3, 4 and 5, right? What is the salary? Salary was 10,000 beginning, that is the same. Then year 2 7% increase, 1.07. Then year 3 also 7% increase, 1.07, right? 11449. Now this is 7% increase, 7%. Then this is also 7% increase. This is 10% increase, and this also is 10% increase. Now what happens if there is a 10% increase? This multiplied by 1.1, it is 1259.3.9, and now it is 13853.29. Now suddenly from 13100 what we had calculated earlier here, 13108, it has now become 13853. What will be 1% of salary? 1% of salary will be 13853 multiplied by 1%, that comes to 138.53. Let me round it off to 139. Okay. Now because of this, what will be the benefit payable? The benefit payable will be 139 multiplied by 5, it has now become 695. From what? From your initial estimate of 655, now it has increased to 695. Now, this change has happened because of what? This change has happened because of changes in actuarial assumption. Because we have changed the assumption, right? From 7% it has become 10%. This has resulted in change in actuarial assumption. Now, because you have changed your actuarial assumption, you will also have to change your benefit obligation, and you will also have to change your current service cost, because earlier you were calculating current service cost considering 131. Now you have to calculate current service cost for 139. Now, in year 4 and year 5, you can calculate considering year 139, because these are not yet passed. But what do we do for things that have already happened in year 1, 2 and 3? Now that part will be considered as actuarial gains and losses, and it will be added to the obligation, right? In this case, because there is an increase, it will be added to the obligation. Please note, this is not a past service cost, because we have not changed the plan. Plan is same. Our estimate of salary increase has changed, right? So if you prepare this table again from year 1 to year 5, let me just copy it down. Now revised table. Revised table will be considering what? Will be considering 139. Will be considering 139 every period. Okay, and your present value will also change automatically. Now here please understand, for year 1, 2 and 3, the changes in present value will be treated as actuarial gains, or in this case it will be an actuarial loss. And for year 4 and year 5, you will revise the service cost based on the revised calculation. So if I pick it up again, this part of calculating of interest cost and obligation. So now let us see how do we update this table. Now as I told you, service cost for this period, that is year 4 and year 5, these two have to be updated with the revised number, and the cumulative impact for the previous period will be treated as actuarial gains or losses. So this 119 and 131 will actually now be 126.36 and 139. So this will be 126.36 and this will be 139. Okay. Now after considering 126.36 as the current service cost, what is the closing balance? 483.64. But what should have been the closing balance, or what is the ideal closing balance? Closing balance at end of year 4 considering revised assumption. What should that be? We know we are looking at year 4. So for 4-year period. So 139 multiplied by 4. Why 139? Because for each year the employee is entitled to 139. 139 multiplied by 4, and we have to discount it by 1 period because we are at the end of year 4. So that will be basically divided by 1.1. You get 505.45. If you are finding it difficult to follow, benefit obligation for 4 years is 139 multiplied by 4. this multiplied by this 556, present value factor for 1 year at 10%. Why 1 year at 10%? Because we are at end of year 4, this amount would be payable at end of year 5, we have to discount it by 1 year. So, there will be 1 divided by 1.1, you get 0.9091 and 556 multiplied by 0.9091, you get 505.45. Now, this 505.45 is the should have been the closing balance, but what is the closing balance? 483.64. So, you have to increase the obligation. That increase in obligation is nothing but your actuarial loss. So closing balance as per existing computation worked out to how much? 483.64. Correct? So, loss. Actuarial loss is 505.45 minus 483.64, which is 21.81. Now, what do I do with this 21.81? This 21.81 will be added here. So, I will create a column called actuarial loss. How much? 21.81. Okay, and accordingly update the balance. You will add that 21.81 and now your balance is 505.45, and next period once you add 139 you get 695, and that is what is payable, right. I hope now you understood what is the meaning of this actuarial loss and why are we accounted in year 4, because originally service costs were accounted as 98, 89, 98 and 108, whereas it should have been 94, 104 and 114. And on this, there will also be an interest cost impact. Okay, considering both of these, the final difference comes to 21.81, which is the actuarial loss. Right? So, this is how we calculate actuarial loss. Accounting aspect of actuarial loss, we will come to it slightly later once we understand in detail as to what are the various components which impact the actuarial losses, what are the various kinds of actuarial assumptions. After considering all of them, we will understand the accounting aspect. Right? Now, this one is actuarial assumption changes. Now, using the same example that we have taken earlier, we will see by making an amendment how do we calculate past service cost. Now, considering the same example that we took earlier, right, now let us say, it was again annual increment of 7% and that holds good, and we have final salary at as 131.08 and benefit is payable at 1% per year. Based on that, we are calculating the service cost and the interest cost. Let us assume benefit payable changed to 2% for every year. Okay, and this change happened at the end of year 4. Now, what does this mean? This means that employee who completes 5 years of service will get 2% of the salary as benefit for every completed year of service. Okay. Now, is this 2% only for year 4 and year 5 or right from year 1 to year 5? This is a retrospective change, or this is a kind of change in which the employee would get benefit also for the past year. So, for the entire 5 years, the employee would now get 2% of salary instead of 1% of salary. So, what is the revised thing? So, just note the revised benefit. Revised benefit is what? 2% of salary. Okay. Now, what is salary? End of year 5 estimated is how much? 13,108, right? 13,108. Now, salary at the end of year 5 is 13,108. Okay. On this 2% of salary. So, benefit for each year is how much? 2% multiplied by 131.08, that comes to 262.16. We will round it off to 262. Now, instead of 131, we are saying we will pay 262. We are actually doubling up the benefit. Okay. The extra benefit is attributable to all years of service. It is not for year 4 and year 5 only. From year 1 till year 5, you will have to pay extra benefit. Now, for year 4 and year 5, whatever is the extra benefit attributable, we will include that as a part of current service cost. But for whatever has happened in the past, for whatever is the services which are rendered in the past, for that period, the benefit that is attributable will be treated as a past service cost, something like a prior period item, not exactly a prior period item, something like prior period item. Whatever is the impact for the current period, we will say current service cost. Whatever is the impact for the previous period, we will say past service cost. Okay, so now the benefit is revised benefit. Now the revised benefit, if we do, is 262. Correct. So, like this, if you do 262, your cumulative benefit also doubled up, and this 238 and 262, this will be the current service cost only, and whatever is the difference and interest impact on that from the previous periods, that will be treated as a past service cost. So, how your table would look like is, here your current service cost will be 238. So basically this revised amount 238 and 262 will be considered as a part of your current service cost. Okay, so I'll just write it here. This is current service cost. Current service cost, this is not a service cost, current service cost, and whatever pertains to the previous period will be treated as the past service cost. So you'll have a past service cost. Okay, so there will not be, just update that. The thing that we need to understand is what should be the closing balance at the end of year 4 after considering amendment. So closing balance at end of year 4 considering amendment. How much should that be? Again, like we did earlier, for 4 years of service multiplied by each year is now entitled to 262 divided by 1.1. So it should have been 952.73. What is closing balance? As computed above, what is the closing balance? It is 595.45. So past service cost is the difference between these two, 952 minus 595, which is 357.27. So 595.45, I'll do it manually, 357.28. Okay, so 357.28 if you adjust as past service cost, then you can see that this gets added as past service cost and you have a closing balance of 952, and next period 262 gets added and the closing balance is 1310, which is nothing but your obligation, right? Now what does this 357 represent? This 357 represents the earlier cost which was not recognized and now we are recognizing. Now if you just want to have a look at the difference for first 3 years, we can consider what is the original present value and revised present value. So original present value we had calculated earlier is 89, 98 and 108. Okay. Present value revised. What is the revised present value? 178.95, 196.84 and 216.53. Okay, these three. Now, what is the difference? Difference is 178 minus 89.74, 89.74, 98.42 and 108.26. Basically, it has doubled up. Now, if you simply sum this up, you will see the difference is 296, but here we are saying 357. Why? Because of the interest cost factor. The reason being, this is end of year 1, change is happening at the end of year 4. So 3 year of interest cost also needs to be factored in. So these are the differences which are at the end of respective year. We have to include the interest component also. So basically we will have to calculate what would this 89.47 be at the end of year 4. So future value we can consider. Now when we calculate the future value, it is 89.47 and we have to move this by 3 years, end of year 1 to end of year 2, end of year 3 and end of year 4. So this will be multiplied by 1.1 to the power of 3, this one will be to the power of 2 and this one will be to the power of 1, and if you sum this up you get 357.27, which is nothing but your past service cost. So basically what are we doing is, whatever is the difference which is attributable to previous period including interest component, we are calculating and arriving at 357.27. The other way to look at this is, I am giving you one more angle to look at this. What is the incremental benefit per year? It is 131. Incremental benefit per year is 131. Number of years past is 3. Okay. Benefits attributable, 131 multiplied by 3, you get 393.393. Okay. Now 393 is the benefit which is attributable, undiscounted value for the previous period. Now how many years are left when we are doing this recalculation? 1 year is left. So discount factor at 10% for 1 year is 1 divided by 1.1, right? And if you multiply this with this, you get 357.27. Okay. Now don't get overwhelmed with this calculation. I have just tried to explain it to you how the numbers impact your ultimate calculation. Finally, what you need to understand, and let me tell you, institute will not be asking you how to calculate all of these things. This is purely for your understanding. That is, if I change the plan in a particular year, how does it impact my final settlement? How do I calculate the past service cost? That is what we are trying to understand here. You will not be tested this in the examination, but your concepts must be clear as to what should be considered as a past service cost and what should be considered as a actuarial gains or losses.